Hi everyone, let's look at Joe's Juices as an example of a capital budgeting or net present value exercise. Joe's Juices is considering the purchase of a special purpose bottling machine for $18,000. The machine is expected to have a useful life of 5 years with a salvage value of $3,000 at the end of its useful life. Depreciation on the machine is calculated on a straight line basis for tax purposes. The plant manager estimates additional operating cash inflows to be $8,500 in the first 2 years, $9,000, $10,000, and $9,500 in years 3 through 5 respectively. Annual operating cash outflows are expected to increase by $2,500 in the first 3 years and $1,500 in years 4 and 5. An initial investment of $2,800 in working capital is required to keep the machine running efficiently. This investment in working capital is fully recoverable at the end of the machine's useful life. Joe's Juices uses a required rate of return of 12% in its capital budgeting decisions and has a 30% income tax rate. Assume all cash flows occur at year-end except for initial investment amounts. So what are we going to do in this exercise? A few things. One, the standard net present value calculation, followed by the simple payback period, and finally, the discounted payback period, and then finally some additional sensitivity analysis, which we didn't get to speak about in class. So there we have the initial investment. So our net present value calculation using the chart approach, our initial investment is the $18,000 as an outflow. When does that happen? Now, the tax rate, this $18,000 is already after tax, so we don't need to put it after tax again. Since it is happening now, there's no additional present value factor, or really it would be the present value of, 1, the whole number 1, 18,000 times 1 is 18,000. Initial working capital investment is $2,800. That also happens now, already after tax. So the extension there, $2,800, also an outflow. Now, any new cash flows, cash inflows or cash outflows that project earns haven't yet been taxed. So we definitely have to make sure that we put those after tax. So years 1 and 2, because there's $6,000, okay, so that's net cash inflow. So the assignment tells us that it's $8,500 as additional cash inflow and $2,500 as a cash outflow. So we net those together to be 6. Nothing too tricky there. Since we have that $6,000 2 years in a row, we can choose to treat that as an annuity. And so we would go to the annuity table, and our present value factor for 12% in 2 years is 1.69. We have to put it after tax. Our tax rate is 30%, so putting it after tax gives us a tax rate of 70. So we do the extension of 6,000 times 70% times 1.69. We get this. For years 3, 4, and 5, since they're different amounts each year, we would just need to use the present value of a single dollar or a present value of a lump sum. Those are in interchangeable terms, but those after tax as well. We have to use the present value factor of $1 for years 3, 4, 5, each with 12%, so there's the extension there. Let's talk about our cash savings or our tax shield as a result of being able to take our capital cost or the purchase of our asset as a tax deduction. So we need to figure out what is our depreciation calculation each year. Well, here is our depreciation down here. Now, unfortunately, whomever devised this example didn't realize that there were too many $3,000 amounts. So this $3,000 amount is supposed to be the salvage value at the end of the useful life. So 18,000 minus 3,000 over the 5 years that we expect to use this for, it gives us a straight line depreciation of 3,000 per year. Okay? Since that is the same amount, it recurs at equal intervals. So each year we can call that an annuity. Now, what is the rate at which we save? Well, we save at the same rate as the tax rate. So there is our rate of savings, or the tax rate, 30%. This 3.605 is the present value of an annuity factor for 5 years, 12%. So do the extension there, that's what you get. Now, jumping to the end of the project's life, we have The cash inflow from the disposal of the machine in 5 years, and that's $3,000. Okay. And then, so the present value factor for 12% in 5 years is that. And then we have our inflow from the recovery of working capital. Neither of those have a tax impact, and we have cleverly chosen an amount so that there were no tax impacts at the end or the disposition of that asset. So adding these all up, this column along the right-hand side here, we have a positive net present value of $3,030.10. What is it we know about that? So long as this project has met all of our qualitative criteria, supports company policies and company goals and all of that sort of stuff, then we are told, according to the theory, that any project that has positive net present value is something we should entertain. And even if that project only has a net present value of exactly 0, what is still true? Even if you have a net present value of exactly 0, what is said to be true is that you have earned exactly your 12% over each of those 5 years and not a penny more. So what is true if you have a net present value then of $3,000? You have definitely earned more than 12% over each of those 5 years. Okay, let's do some additional analysis. So additional analysis here is the simple payback period, and somehow the simple payback period tells us that we get our initial investment back in 2.93 years. Now notice that this calculation is very simple, and it only looks at the net operating cash inflow, so it doesn't really even include everything like the depreciation tax shield. So here's the initial $18,000 as the cash outflow to buy the capital asset. In year 1, I know my net cash inflows are 6. In year 2, I know my net cash inflows are 6. And to recover $18,000, I just would need 6, 6, and 6, wouldn't I? So I recover that $18,000 just before the end of that 3rd full year. So it's 2 years and something. So over here, I know that in the 3rd year, I need to recover $6,000 of the $6,500 that I will earn in that entire year. So what fraction is 6 over 6,500? It's 0.93. So using simple payback, it tells me some number of years before I get that initial investment back. Now, if we were to be a little more advanced, now we would use the discounted payback period. So here's our discount factor. Okay, recognizing again that there is that time value of money inherent in our long-term budgeting calculations. What it's going to tell me is that it simply takes a little bit longer in real life, if you allow for that discounting, 3.6 years to get your money back. Now we're going to do what's called sensitivity analysis, and the reason for our sensitivity analysis goes like this. You and I know that basically every number in our net present value calculation is an estimate. Probably the upfront purchase price is about the only thing that is known with certainty. So because all of those numbers in our net present value calculation is an estimate, we could do endless iterations of net present value calculations if we were to say, well, what if our net cash inflows went up by 50, down by 50? What if they were $200 in the 2nd year? And on and on. So probably you don't want to do endless iterations of net present value calculations, but we're going to take a shortcut and employ what we call sensitivity analysis to speed up some of that what if kind of thinking. Okay, so here's a question we could reasonably ask. What is our break-even level of cash flows for this special purpose bottling machine? Break even. Well, we know that the upfront purchase price of that machine is $18,000. So somehow, something equaling $18,000 would be my break-even level of cash flows. But I have 5 years over which to earn those break-even level of cash flows. So let's see what the ordering or the thought behind this calculation would look like. So the capital cost of the machine is $18,000 now. So some amount of annual net cash inflows, so cash inflows minus cash outflows, expressed in present value format would have to equate to your original purchase of the $18,000. So we'll let X be this sum amount of net cash flows. Okay? So the present value of an annuity factor for 5 years and 12%, as you and I looked at before in that table above, is 3.605. All right. So the annuity factor of 3.605 times something, or X, equals 18,000. All right, well, let's solve for X then. All right, numerator over denominator, we know how this works. X equals $4,993 after tax. Well, that after-tax number is not really expressed to me in the same terms as the numbers that I'm given in the problem. The numbers I'm given in the problem tells me I have cash inflows of $8,500 in a year minus cash outflows of $2,500 in a year. That's just for year one. And then when I put the $6,000 into the net present value calculation, what was the first thing I did? I put it after tax. Okay, so I need to put this after-tax number before tax. Before tax. I'll let you just think about that. The numbers given to us in the problem up above are all before tax numbers. Okay, so I'm going to take this after-tax number and put it before tax. So how would I do that? Well, I would need to divide by 1 minus 0.3, so 70%, to get the before tax amount of 7,132, okay, $7,132 of net cash required each year to break even. So what does that really represent? So whatever it is that's bringing in cash for this particular project, so operating revenues minus operating expenses plus the cash saved from that depreciation tax shield plus the salvage value from the end, whatever cash flows are inherent in that project boiled down and net together needs to give us at least $7,100 each year for 5 years before tax, or this $4,993 after tax for the project to break even. Okay, one more sensitivity analysis type of question. Number 2, by how much can our estimated annual cash flows used in the above net present value calculation be wrong before the project just breaks even? That's a rather deep thought, isn't it? Well, again, going back to this idea that all of our cash flow amounts are really estimates, would you want to be evaluated for taking a chance on a project that's just inherently based on estimates? So you want to have some sense of how wrong you can be or how off you can be before it really starts to matter. All right, so if you look at the solution, we ended up with a net present value of that project of being $3,030.10. And so it wasn't zero. If we had a net present value of 0, that means the project would already be at break even, and all of the cash flows used already in that calculation are just the bare bones to even get the project to break even. So how much of this $3,030, how much of that could we use basically each year until it turned into 0, thus showing us how much our cash flows could be wrong by for each year of 5 years before the project only breaks even? Okay? I think as we do this calculation and you think through it, it'll become crystal clear. All right, so we're trying to basically say how much each year could we reduce our cash flows to take the net present value of this project from $3,000 down to 0. Okay, so let's use the same sort of sequence and methodology as we did above in our other sensitivity analysis question. So let's take our $3,000 net present value, divide by that present value of an annuity factor, and what we're going to do is unpresent value it. Sweet terminology, right? So we get $840.53 a year, but that is an after-tax number, so let's gross it up and make it before tax. So we gross it up, and before tax, it's $1,200. Okay, you can on-tax affect it if you want, right? So what does that mean, $1,200? Well, if we revised our annual cash inflows downward by around $1,200, not a month, but by a year, that doesn't need to say a month, before tax, the project would still break even or be worthwhile. Therefore, basically each year we have a margin for error of about $1,200 that our estimates could be too high. Okay, I hope that helps.